Congratulations on completing Module 2. You're well on your way now. We're in the balance sheet and looking at assets and liabilities. Module 2 was comprised of a couple of different courses, but they are a progression inside the balance sheet of a financial statement. Topic 1 was on short-term assets, Topic 2 was on long-term assets, and Topic 3 was on liabilities. There is a fairly detailed summary of Module 2 that you can find in my courses. The slides in this presentation are the highlights of the summary. Topic 1, short-term assets on the balance sheet. As you know, short-term assets are assets that are already cash, will become cash, or will be used up in 1 year. The learning objectives in this topic were valuation of accounts receivable, looking at how discounts, returns, and bad debts impact valuation, look at different types of inventory, calculate impairment of inventory, and apply cost flow assumptions. So those are the key topics within Topic 1. Short-term assets have the following key takeaways. On the left side, I'm just going to read through these and just mentally note, did I understand these? Yes or no? If the answer is yes, great. If not, go back and review them so you can lay a very solid foundation for the balance of this course. Accounts receivable, net realizable value of receivables, cash discount, sales returns, bad debt, percentage of sales method, provision for doubtful accounts, inventory, lower of cost to market, inventory impairment, LIFO, and FIFO. So those are the key terminology. On the right side, we have the knowledge and skills. And again, ask yourself these questions. How do you calculate net realizable value for receivables? What is the accounting for cash discounts and sales returns? How do I estimate bad debts? How and why do you impair inventories? And what are the various cost flow assumptions? And how do they impact the final balances of cost of goods sold and ending inventory accounts? Here is some details on some of the typical transactions that we would find in accounts receivable. Number 1 is we sell on credit. So accounts receivable goes up because somebody owes you money, that's an asset, and revenue goes up, and that's $10,000. Notice that revenues are in the green section or income statement, and it connects to the balance sheet inside retained earnings. So that's why we see over here $10,000 as a positive impact on net income, and here we see it translate into the balance sheet and just carries through over here. That's the first transaction. Second is the good news, the customer pays the receivables to the company. So here we got $9,800 and it reduces $10,000. I said, whoa, what happened to the other $200? Well, inside the detail, we see that they were offered a discount if they paid early. So if they paid within 10 days, they get a 2% discount. So they paid you cash of $9,800. It extinguished or satisfied $10,000 worth of receivables, and we reduce our revenue because we really didn't receive $10,000 when all was said and done. We only received $9,800. So that's why it's a negative $200 here. So that's an example of a discount taken by a customer. The third example is sale of a credit. This is just to set up another scenario. So we already know how this one works. Receivables goes up by $100,000 and revenue goes up by $100,000, and the revenue of $100 increases retained earnings by $100,000. Transaction 4 is create an allowance for bad debt. And here the assumption is given over here, 3% of sales. So 3% of 100,000 is 3,000. This was a little tricky, so hang on to your hat a bit, all right? So it's an expense of negative impact on income. So it's a negative 3,000 for a bad debt expense. And then we create an allowance for bad debt of 3,000. Now notice that it's an offset to accounts receivable. This is an example of a contra asset account. It goes against another asset. So this 3,000 is tied to this 100, and it offsets that 100 for what we think we'll ultimately receive. Now notice nothing bad has happened yet. We just sold $100,000 worth of product, but we estimate based on history and judgment that 3% of those will not be collected. And there are many reasons why we don't collect. Maybe there was a damaged good, maybe it was lost in transit, maybe they claimed they never got it, whatever it is, or maybe they have a bankruptcy and they can't pay it even if they wanted to. So there are many, many, many reasons that you will not collect all your accounts receivable. So this is a way for us to be conservative and charge our income statement for items we believe we're not going to collect, and then not overstate our assets by providing an offset to the accounts receivable balance. In this case, we're saying, even though we know $100,000 worth is due to us, we also know that we're unlikely to collect every penny of that $100,000, so we estimate we need a reserve of $3,000 for all those eventualities which may occur. All right, so that's the idea of what's called the reserve method for accounts receivable or bad debts. All right, number 5 is, we have a bad debt. And in this case, Sam Smith goes bankrupt, and it's right down here. So we are going to write off that receivable. Now, this is another one that often is confusing to students. A lot of students say, well, Sam Smith didn't pay. That's an expense. No, it's not. Why isn't it an expense? We knew somebody wasn't going to pay us. Now we know who. So this 500, you see right here, is using some of the reserve that we established. So we're going to reduce that reserve, and that's a plus entry inside of this contra account. And then now we're no longer going to collect that receivable. So we're going to reduce our accounts receivable by the 500. It's gone. We know we're not going to get it. All right, so these are 5 of the typical transactions inside accounts receivable. The next items we're going to look at relate to inventory. And this is the item we call cost flow. And that's an assumption of which ones did you sell? Because often we buy inventory and they're identical goods. We buy 10 of an item day 1. We might buy another 5 tomorrow. Then some customer comes in and buys 3 items. The question is, which one did they buy? And so FIFO, LIFO, or average answers that question on how do we make the assumption of which inventory items were sold to the customer. And give you an example, if it's FIFO, first in, first out, right? FIFO. That means when that customer bought 3 things, they bought the first 3 that we bought, the oldest 3, another way to think about it. So that's FIFO. LIFO is the last in, first out. So that means the last 3 that were purchased were the ones that the customer bought. Kind of like you when you go buy milk. You want to buy the freshest milk, not the oldest milk, right? And then averages, I don't know what it is. So I'm going to take the average of all the items we bought and just say on average, that's what the customer bought. And on average, that's what remaining in inventory. So that's the idea of FIFO, LIFO, and average inventory. Okay, those are the words. Let's see how the numbers work. All right, so hang with us. A lot of numbers here. The left side is the detail of what happened. We started the year on January 1st with 20 units at $15 per unit with a value of what we paid of $300. Then we made 3 purchases in January of differing amounts at differing prices and therefore different totals. Now, when we add up all those items that we bought 20 before, 150 in January, so we have 170 on hand. We spent 300 before, another 29.25 in January, so we spent 3,225, right? That's the total. So that's important to know because at the end, those have to go somewhere. Where do they go? It can either be sold and therefore it becomes cost of goods sold, or it's still here, which means it's in inventory. All right, so then let's look at more detail. How many did we sell in January? Well, we sold 40 units at $35 per unit for a sales value or sales revenue of $1,400. Now here's the question. What is the cost of goods sold under FIFO, LIFO, and average? So here we have to just take it nice and slow and just remember what these things mean, and it should all just work out, right? Let's see if that's true. We know we sold 40. We have to say, well, what is the oldest 40? Well, the oldest 40 is this group of 20. That's this 20. And then the next group is in this group of 50 that we bought on January 5th. 20 of those were also sold under this assumption. So 20 plus 20 is 40. Now we say, well, what was the cost of those goods sold? Hence the name cost of goods sold, right? $15 for the first layer, $16 for the next layer. We multiply those across. 20 times 15 is 300. 20 times 16 is 320. Add those together, 620. So that says those products that we sold, 40 in number, cost us $620 if we assume a FIFO cost flow assumption. We can go work backwards now. What's ending inventory? Well, how much of the first layer is around? None. It's gone. How much of the second layer is here? Well, we still have 30 at 16 is 480. How much of the third layer is here? All of it. 75 times 20 is 1500. How many of the fourth layer are still here? Answer, 25 and times 25 is 625. Add those together, we have 2605. Now, that's a long way to get to the answer. The shortcut, as you may have noticed, is you take the total cost of goods available for sale, 3225, minus the 620 equals the same number. So in a sense, I just proved that everything worked, right? That what we subtracted was indeed subtracted from our inventory, and the remaining amount, we know exactly which layers they belong to. The income statement in this FIFO example is our revenues. We know that. That's 1,400. That was given over here, right? 40 times 35 is 1,400. That's what we got. The cost, which is what all this was all about, was determined to be 620, which we did right here to determine COGS under FIFO. So 1,400 minus 620 is 780. So we're done. The gross profit for the month of January was $780, right? So that's one. Really? We have two more? Yes. Sorry, two more. So next is LIFO, which stands for last in, first out. The facts are the same, so we can jump right into the numbers. Under LIFO, it's the last inventory which you sold. So we know we sold 40. So let's go from the bottom up, the newest to the oldest. 25 of the 40 is sold. So that's the newest layer, 25 times 25 is 625. But we sold 40, so we need another 15. So we go next layer, 15 out of the 75 were also sold. So 15 times the cost of 20 is 300. Add those together is 925, which is the cost of goods sold pertaining to the last 40 units that we had in inventory, and those are the ones we sold. We could do the same calculation we did previously. 3225 minus 925 equals 2300. That's a shortcut. The long way is we just build it back up. The first layer is still here. That's the 20 for 300 bucks. The next layer on January 5, it's still here, which is 50 units at 16 is 800. But of the 75, there's 75 minus 15 or 60 remaining. So 60 times 20 is 1200. Add those together and voila, it's the same. It has to be. So it all squares up and we did it right. Now let's look at the income statement. The revenue is still the same. The customers paid what they paid us. So it's 1,400 is what they paid. But this time our COGS is 925, leading to a gross profit of only 475. Now notice the big difference, 780 versus 425. And that is entirely based on the cost flow assumption. We don't know which ones the customers bought. We're making an assumption of which items of our inventory were purchased by the customer. And that is where the LIFO, FIFO come in. Now, if we say, I don't know which one they bought, let's take the average. That's the last one, which is essentially the weighted average, more precisely than just average. And I'll explain it, of course. Now, all we have to do is compute the weighted average. So the weighted average is you take the total paid, 3225, divided by the total units that you purchased of 170, and it's over here, equals 18.97 per unit. Now notice the 18.97 looks about right? We bought some at 15, we bought some at 25, so yeah, it's plausible that it's 18.97. Now notice we did a weighted average. We didn't simply look at these costs and divide them by 4. That would be just the average, but that doesn't work because in some cases we bought 75, in other cases we only had 20. So an average would not really work very well because it doesn't reflect how many units we bought at those prices. That's why we have to do a weighted average, not a simple average. All right, so we have 40 units times this 18.97 equals 758 cost of goods sold. We could do the same thing. 3225 minus 758 equals our ending inventory of 2468. And we could build it up in reverse and saying, okay, we had 170, we sold 40, so we have 130 left. 130 times 18.97 equals that same number of 2466, right? So again, it squares up. All right, now we go to income statement, same 1,400, minus the 758, and we get profit of 641. So it should not surprise you at all that the weighted average is in between the FIFO and LIFO, both in terms of inventory value and in cost of goods sold and in profit. So look at the difference. Under FIFO, we report the highest profit of 780. Under LIFO, since we expense the most expensive items, the most recent items, we only made 475. And under weighted average, we have a number in between, 641. All right, so I hope that made sense. That's a side-by-side comparison of the three cost flow assumptions of FIFO, LIFO, and average cost. Here are some parting thoughts on current assets. The item here is for Apple Incorporated, and it's highlighting the current assets. Now, look at current is separated from non-current. That's classified. And it's presented in order of liquidity from the most close to cash to the furthest away from cash. So cash is cash, so that's first. Next is marketable securities, which are stocks and bonds that you could sell immediately and turn it into cash within days. Accounts receivable, we hope our customers pay us quickly because they owe us the money. So that's the next most liquid. Inventories, we're 2 steps from making cash. We have to first sell it, and then after we sell it, we have to then collect it. So that's why it's slower than accounts receivable. Next are vendor non-trade receivables. Those are under agreements with vendors, and they will take likely longer than 30 days to pay us. And other current assets, and these are things like prepaid insurance, where it's going to be around for the next 11 months, and therefore it's going to take the longest to become cash. So that's how we put it in order of liquidity when we present current assets. All right, topic 2 was long-term assets, looking at the balance sheet once again. And these are assets that have a life and value to the company of more than 1 year. Our objectives dealt with what are the asset recognition criteria, when do we capitalize those costs, calculating depreciation and accounting for it, and then gains and losses for asset disposals, and look at how gross PP&E, net PP&E, and accumulated depreciation affect our balance sheet, and then account for asset impairments. The item in red is what we're going to cover in this summary. In the longer form of the summary, the Word document, all of these are covered, right? But for here, we'll just look at depreciation expense. What are the key takeaways? On the left side, our terminology. Again, just think about these as I read them and tick, tick, tick. I hope you got them all. If not, you know that you should go back and learn it and lay that foundation before you move forward. So let's get it through it. Asset recognition, capitalization, depreciation, straight line method, asset disposal, asset impairment, net realizable value of fixed assets, gross PP&E, net PP&E, and accumulated depreciation. I hope all that made sense. We're going to actually touch on the things in red. If not, you know where to go. And on the questions, which cost should be capitalized on the balance sheet for fixed assets? What is depreciation and how does it impact financial statements? How do you calculate gains and losses after an asset disposal? And what are the differences between gross and net PP&E? And when do you impair the long-term assets? The example, as I mentioned, is on straight line depreciation. It's by far the most commonly used depreciation method, and we charge the same amount for each year of the useful life of the asset. That's why it's called straight line. And the total amount that we will depreciate equals the original cost minus the salvage value that we estimate at the end of the asset's life. We estimate it at the beginning of the life in order to do the depreciation expense calculation. So here's an example. Company acquires machinery for $30,000. It has a useful life of 5 years and a salvage value of $5,000. The depreciable base is $30,000, the original cost, minus $5,000 in salvage value equals $25,000 depreciable base. Then the useful life of 5 years. So annual depreciation is the depreciable base of $25,000 divided by the useful life of 5 equals $5,000 per year. Now, if we happen to buy this at a different point in the year, not the first day of the year, then we'll have to get it down to monthly depreciation. But that's beyond what we're doing right now. Okay, here's a scenario, and we originally bought it here. We spent $30,000 and we owe it to our vendor. That's just an assumption. And then we want to record 1 year's depreciation. Again, here's that contra asset account. In this case, the accumulated depreciation goes against the gross amount we paid. And then the expense is depreciation expense for a year. So we essentially used up $5,000 of this machinery in that first year. It goes from the income statement over here to the balance sheet. We're in balance, negative $5,000 on each side. And our net asset value for this machinery is now 30 minus 5, or $25,000. We call that the net book value, right? We have gross PP&E, which is the original cost. We have the accumulated depreciation, which are all the ones that we've expensed so far in the life of that asset. And then the net is the gross minus the accumulated depreciation, right? So we just ticked off some of those terms. There are other types of non-current assets too. Some might be marketable securities that we're going to hold beyond 1 year. And those examples might be a bond. You might buy a 5 or 7 year bond and have the intention that we're going to hang on to it because we have no need. And we anticipate that it'd be nice to have cash flow that's reliable coming back to us in the 5-year time frame of that bond. Goodwill, which arises when a company buys another company and pays in excess of their fair value to buy it. An example of this, a pretty big example, is Google acquired YouTube for $1.65 billion, and almost all of it was goodwill. That was an amazing amount of money that Google paid for YouTube, because YouTube was comprised of about 25 people up the block here in San Bruno, and they didn't own very many assets. So what they did have was the big lead on streaming video. And for that innovation and their brand value and their name and their capability, Google, I guess, was happy to pay $1.6 billion for it. And it turned out to be a good deal, right? Because Google's YouTube is quite an impressive asset that's in the company, and I'm sure it's worth far more than the $1.6 billion that they paid for it. In fact, you're watching this video on YouTube, coincidentally. The next are acquired patent rights. So here's where a company buys the rights to a patent from the patent holder. In this example, if Apple licenses a patent from another company that it's going to use for several years, it's going to pay for that privilege. It's going to sit it here on the non-current asset, and over the length of that contract, they're going to be expensing the cost of that patent right to their income statement. The last item are deposits. They could have put a deposit to rent a building, and that's where it sits, clearly more than 1 year, because most leases last from 5 to 20 years. So it's definitely a long-term asset. All right, topic 3, liabilities. And here is just money we owe to others, and we just classify them based on current and non, and we put them based on the order of payment. It's less clear, not quite as clear as the current assets, but we typically start with accounts payable, which we intend to pay pretty quickly. Our objectives were to look at liability recognition criteria, to value the liabilities, to differentiate between short and long term, and then how do we account for short-term liabilities when it's embedded inside of a longer term liability and it's split essentially, and then understand bonds, the pricing and transaction, the issuance, after issuance, and maturity. Now notice that I've highlighted in red ones that are fairly simple to cover in this video. The bonds, which is much longer treatment, you'll find a better explanation inside the notes to Module 2. The takeaways in terms of terminology and concepts are, all right, listen and tick off in your brain: liabilities, face value, principal, coupon rate, coupon payment, maturity date, principal, bank loan, bond, unearned revenue, and bond certificates. Tick, 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 or not. Next, as far as knowledge and skills, what are the liability recognition criteria? How do you value different types of liabilities? What are the special features that you may find in a bond? What is the accounting for bonds at the time of issuance? What is the accounting for bonds after issuance? And what is the accounting for bonds at maturity? So those are essentially the life cycle of a bond. Here we'll look at the balance sheet for Apple, and what's circled in green are the liabilities. It's again classified, so short-term on top, long-term on the bottom. It's presented in current first and then non-current. Accounts payable, I'll just point out a few of them that are more generalized that you'll see in almost every company. Accounts payable are monies you owe to your vendors. Deferred revenues are payments you've received from your customers in advance of you earning it. So it sits here as a liability until you earn it. Accrued expenses, which are expenses that you can estimate, things like income tax or bonuses that you will pay to your managers and employees. So those are examples of accrued expenses. Think of it as something the company can determine, and they're not necessarily going to be an invoice. And then taxes payable, that's a type of accrued expense. And financial obligations are monies we owe to other financial sources. It's different from money we owe to like a vendor, or money we owe to an employee, or money we owe to a taxing authority. This is money we owe because we borrowed money, right? We have accrued interest payable, which is money we owe to the bank or bondholders for the pleasure of using their money. There are bonds, which are long-term. Bonds are typically 5+ years in maturity. And then bank loans, which could be short-term or long-term. Here they are in the long-term section. And lease obligations, which span multiple years, and we would present them in both the current and long-term, depending on how quickly we have to pay the obligation. So those are examples of liabilities that we see typically on many corporations' books. Some general comments about liabilities. They're classified. We already covered that a couple times. And the current is for what portion we will pay in 1 year, and the long term is what portion we're going to pay in future years. In this examples, we have a short-term loan where we have accounts payable for inventory of $20,000. What happens? Inventory goes up, so that's a plus. Liability goes up, so that's a plus. We owe $20,000 because we got $20,000 worth of inventory. That's an easy one. Let's deal with one that's a little trickier. This is a bond. So we sold the bond at a discount. So we got $100 million at face value, but we only got $99 million for that bond. So the entire bond payable will ultimately be $100 million at maturity. So that's why bond payable is the full $100 million. The amount of cash is what we got, $99 million. So the difference, in this case, it's a discount bond, subtracts 100 from the bond payable. So this side is 99 and this side is 99. We're in balance. Again, look to the notes for more extensive coverage of how that happens, how bonds are issued at 99 instead of 100, and what happens over time to that discount, right? So that's covered in the notes. A loan payable is where we borrow money from a bank, and the loan is going to be repaid to the bank with interest. Now, loans specify the maturity schedule. Sometimes they're paid within a few months, sometimes they're paid in a few years, sometimes they're paid in a systematic way over that time frame. Each loan may have a very different maturity schedule. So here's an example. We borrow $5,000 from a bank, so we get cash, it goes up by $5,000, and we owe the bank a loan of $5,000. Then we have interest and principal that we pay, and we pay off that loan. So $5,000 is the amount of the principal we repay, and the interest is 10% annual rate, but we only had it outstanding for 6 months. So 10% of 5,000 is 500. Half, or 6 months worth, of 500 is 250. So we pay the bank $5,250, which is comprised of repaying all the principal of 5,000 and an interest expense of 250. So that's the transaction. It all balances because 5,250 equals the 5,000 and the 250 that comes over from the income statement, right? So that's how we would record the original borrowing of the money and then the repayment of the loan with interest. Product warranty. Most products have a warranty. It could be 1 year, it could be 3 months, but it is a warranty. If something goes wrong, the company is obligated to fix it or replace it to the customer. GAAP requires that you make a provision, like a reserve, for those warranties, because we know if we ship 1 million products, something's going to go wrong with a couple of those items, right? So we estimate how much we expect in warranty liabilities, and we record it up front, similar to what we did with bad debt. Even though no bad debt had yet occurred, we create a reserve at the time that we sell products. Same thing here. At the time we sell products with warranty, we estimate the amount of warranty reserves we need to cover the 3 months or the 1 year, whatever the provision is for that warranty. So let's look at an example. Sometimes numbers are easier than the words. So we sold $1,000 worth of bikes. Okay, 1,000 in cash, 1,000 in revenues. Next we say, well, what do we estimate as far as warranties on $1,000 worth of bikes? And the estimate is 75. So we have a reserve, which is a liability, and an expense of 75. Next, something goes wrong. A bike comes back for a repair, and the cost of the repair was $30. We paid some outsourced bike shop, let's say. So we have cash goes out by 30, and we're using the reserve. We knew this would happen. We estimated 75. Now 30 has happened. So notice it's not an expense. We've already expensed the reserve. We are using the reserve when we make a repair. And finally, all warranties are expired. So out of all those bikes we sold, there was only that one problem. So we had 75 minus 30, or 45 left over. We don't need it anymore. So we can then reduce a liability, because there is no more liability, and we'll actually have a positive item as an expense, because we're essentially reducing the expense that we may have overcharged at the time of establishment of that reserve. So that is the life cycle, if you will, of a product warranty. We've completed Module 2. Congrats. That's short-term assets, long-term assets, and liabilities. And remember, there's a much more detailed recap in the My Courses summary. Next comes Mod 3. Mod 3 is the last part of the balance sheet, shareholders' equity. Then we'll jump into the cash flow statement, and then look at statements and accounting principles in more detail, and then touch on SEC filing and resources. Action-packed. Congrats on finishing 2, and jump on to Module 3. Enjoy.